Thank you very much, Natalie. It has been a long time. I think you said since freshman year of college, 7th grade. I think we've got you beat there, Courtney. I actually did joke with Natalie that one of the things I meant to do over the weekend was pull out some of our old, I think it's a Robinson Rampage, our yearbooks, and pull some pictures, but I didn't get that done. So probably to both of our benefit with that. So I do have my thing here. It looks like, Matt, you're getting the thing switched over. So I will vamp here for a couple of minutes and go, hey, there we are. We are running, we are going. So it is every year at this time, now I think for 22 years, I have done an annual housing forecast. It started for Wichita and now continues to include all of the major markets across the state. And I have copies of the Wichita housing forecast at your tables. And so make sure we're running and going with there we go. But if you would like to see my presentation slides, copies of them are available on the Center for Real Estate's website, wichita.edu/real estate. And right there on the home page, you'll see a link for the downtown Rotary presentation that we have here today. And so I also included copies of the Wichita forecast on your tables, and these publications are available because of support that we receive from a lot of generous sponsors. And for Wichita's forecast, it's Security First Title and Ameritrust Credit Union, and we're very, very grateful for that support. And also for the partnerships that we've had with the realtor associations across the state. We actually have a contract with the Kansas Association of Realtors at the Center for Real Estate, where we access every multiple listing service in the state, and we then make them all talk to each other because they don't like to talk to each other very well, and combine them. And we actually, if you see reports that come out reporting home sales activity in Kansas, in Wichita, in Lawrence, in Topeka, we as the Center for Real Estate actually produced and compiled all of those statistics for the realtor boards. But it's because of this partnership that we actually have access to the data. So it's very mutually beneficial, and we're very grateful for that. And so with that, let me jump into what I have. When I talk with real estate agents, I often will go and talk about the economic environment. And since I don't want to steal Jeremy Hill's thunder this week when he does his economic outlook forecast this Thursday, I'll just say the underlying economy and labor market still looks pretty solid. And so from a standpoint of how that would impact housing markets, the concern that I always have is, will people have a job? Will they feel confident about it? Will their incomes be rising? And at the present time, that all seems very stable. I am actually very, very hopeful that we are going to navigate a soft landing, but even if we do go into a recession, it would be my expectation it would be a very, very mild one. And so for the most part, the labor market doesn't play a big role in my forecast for what we see going forward in housing markets. Instead, the concern is what's happening in financial markets and the mortgage rates. And I actually am relatively optimistic about how things will look going forward. We're all very familiar with how rapidly mortgage rates increased throughout last year, and people talk about it being the highest levels that we've seen in 20 years. I'll talk more about that in just a moment. But I think the real key to think about, could mortgage rates accelerate and go much higher than where they've been, really depends on expected inflation. As long as inflation is coming under control, then we should be in a place where mortgage rates have probably peaked. And the line that I want to point you to on this is actually the green line that's at the bottom. It's a number called the 5-year break-even rate. And for time, I won't go into how it's calculated, but essentially you can think this is what the financial markets believe the average inflation rate will be over the next 5 years. And why do I say that? It's exactly like the Vegas line. There are people betting literally hundreds of millions of dollars on these securities. And they're putting money on either side. Will inflation be higher? Will inflation be lower? And this is the collective wisdom of the market. And so in my view, this is saying on average over the next 5 years, inflation will average just a little over 2%, which is in line with the Fed's inflation target. The one thing that's been interesting with this that I don't think it's gotten much discussion, but one thing that's impacted mortgage rates recently has been the mortgage risk premium. Traditionally, we think of mortgage rates as being tied to the 10-year Treasury. That would be a benchmark that we would use. And historically, we go back to 1985, the difference between the 30-year fixed mortgage rate and the 10-year Treasury, that's the green line on the bottom here, its typical value has been between 1.5% and 2%. The median is 1.7%. Currently, it's just a hair under 3%. So that mortgage risk premium right now is very, very high. And quite frankly, I'm not sure why. But it's something that you've seen when it's gotten this high in the past, it hasn't stayed there very long. So once again, I'm hopeful. Expected inflation seems to be coming down. I don't think this higher mortgage risk premium is going to stay a little bit higher. And so that then translates into the forecast for mortgage rates. And the National Association of Realtors is the forecast that I've used here. They're forecasting that the 30-year fixed mortgage rate will drop back down to 6% by the end of next year. Those who've seen my presentations in the past know that I often use the Mortgage Bankers Association's forecast. I actually pulled them out this year because their forecast was so low that I just didn't feel comfortable with it. It has since come up. Their forecast right now for the end of next year, 5.4%. That seems low to me. If you had to put my feet to the fire and say, where do I think mortgage rates will be? I think it will be between 6 and 6.5. But again, they put a lot more time and resources in forecasting this. So I presented the National Association of Realtors number there. But still, you look at that chart and you can see how high mortgage rates have gone compared to where they have been for the last 15 years. The problem with that comparison is that the past 15 years have been, the technical term that I have used in many presentations for a long time is a situation of funky financial markets. Ever since the financial crisis, the mortgage markets have been totally abnormal. And so for us to go back to a mortgage rate that is between 6, 6.5, 7, even 7.5%, that's really more consistent with what I would view as a typical mortgage rate when we have low inflation, healthy economic growth, and again, nothing funky going on in financial markets. So again, I think that this forecast is in the right ballpark, but it is certainly the case that the increase in mortgage rates has had a really big impact on housing markets across the state, indeed across the country. And so home sales activity this year are down about 14% year to date compared to where they were last year. At about 6,400 homes that have sold so far this year, that's the lowest level through August since 2015. Demand has been impacted by the decline in mortgage rates. But the story that I think is more important and that's easy to miss in all of that is that supply is still really tight. This is the number of active listings, and I took it back quite a ways here, back to early 2000s. The number of active listings that are available for sale on the market in the South Central Kansas MLS. And you can see that the blue shaded regions, they're a little hard to tell, but back in 2008, 2009, that was the Great Recession from the financial crisis. We had excess housing inventory then, an oversupply of homes. It was very much a buyer's market in those years. But since then, we've steadily whittled away the number of active listings. Essentially, we have been selling, not we, although my realtor friends have been selling more homes than all of us have been adding back to the market and putting inventory. When I was doing presentations back in 2018 and 2019, I was forecasting that home sales activity would be essentially flat, not because of a lack of demand, but because we had gotten to a place where inventories were so tight that it was difficult for buyers to find the homes that they wanted. What happened during the pandemic? The incentives that the federal government put forward, coupled with the activities of the Federal Reserve, juiced up demand through the roof. And there were people just coming out of the woodworks trying to buy, and we had the craziest housing market that I think anyone has ever seen. And that ended up causing inventories to get even tighter. Now, they've come up a little bit over the course of the last several months, but you can see we're still just a little over half of the number of active listings that we had back in 2019 prior to the onset of the pandemic. And to understand where that is, one of the ways we measure balance in the housing market is through a number called months supply. We take the number of homes that are available for sale and we divide it by the average number of sales per month over the prior year. So if we have 1,000 homes on the market and we sell on average 200 homes a month, then we would say we have 1,000 divided by 200, a 5 months supply. We normally think of a balanced market as one where we have a 4 to 6 months supply. We haven't had a 4 month supply in Wichita since 2015. And we got down to about a half month supply in the peak selling frenzy in the wake of the pandemic. Right now, we're at about a 2 month supply, which is still a lower level than it was prior to the onset of the pandemic. Inventories are incredibly tight, and there just aren't very many homes available for sale for those buyers that are in the market, even though demand has softened. The homes that are on the market are continuing to sell very, very quickly. I look at the market and I think of normal, if you go back prior to the financial crisis, we were typically sitting around 40 days on market was a typical time. Half the homes would sell faster, half the homes would take longer to sell. Again, that number went up in the wake of the financial crisis, and then it came down as we whittled away those inventories. It was down to about 20 days on market prior to the pandemic, and now we're sitting at about 6 days on market. Half of all homes that sell in Wichita sell in less than a week. They are also selling at or above asking price. So this is the percentage of homes that sell at a discount to the original list price. And again, I've tried to put a long perspective here to give some framework. Going back prior to the financial crisis, we saw that 60% of homes would sell at a discount from the original listing price. That's normal, right? You think, oh, I put my house on the market, I'm gonna list it for 200, you come in, you make a counter offer for maybe 190, maybe we settle at 195, it's sold below the original asking price. 60% of homes, that's what would typically happen. Prior to the financial crisis, we'd gotten down to a place where we were at about 60 again, so that was okay. But since then, we dropped down where it's about 40% of homes are selling at a discount. That means 60% of homes that sell are selling at or above the original asking price. So what is our home sales forecast? We have this declining demand, but we have really, really tight inventory. Our forecast is that home sales activity in the Wichita area will end the year down about 10.4%. But I think basically the worst is over in terms of the drop in demand. And so our forecast is to be essentially flat, a very slight decrease next year. That is driven primarily because of inventory issues more than it is demand. If we had more homes available for sale, there are people out there who would be willing to go out and buy if they could find what they want. So we have a situation of really tight inventories. What does that mean for home price appreciation? Well, of course, in the face of the pandemic stimulus, we ended up with home prices that just took off. Peaked out a year ago at 16.8% home price appreciation in Wichita. That's just absolutely unheard of for the central United States. But when you had a shortage of inventory to begin with and then a very, very strong demand, that's what you have happen. Home price appreciation is slowed, but here's the thing I want you to remember on this picture. Look at the dark black line. That's zero. That zero, if you're above the zero line, it means that year over year percentage change is positive. Home prices are still continuing to appreciate. Sometimes people look at the downward slope in the line and they think they're falling. No, they're just not appreciating at the ridiculous pace that they were a year ago. In second quarter, which is the latest data that we have so far, Wichita home prices were up 6.2% compared to the prior year. Our forecast is that this slowing will continue, but we will still have solid, stable home price appreciation. 4.2% for 2023 and 3.4% in 2024. For perspective, you go back prior, other times when we've had good, healthy appreciation, 3.5% to 4.5% is really strong, solid appreciation for the Wichita housing market. So those of you who are thinking you can wait and get a really good deal when prices come down, I'm sorry, that's very, very, very unlikely. So when you find the opportunity, take it and run. So how do we deal with the supply problems? Well, the short answer is this is not something that came about overnight. It's taken us about 15 years to get where we are. And I once had a friend that said, if you walk 3 miles into the woods, turning around is the first step, but you shouldn't expect to be out of the woods until you walk 3 miles back out. And so in the wake of the financial crisis, we're still living with all of that. New home construction just absolutely collapsed. And again, I went all the way back to 1990 here on this picture so that you could get some historical perspective. We dropped down as low as about 750 permits per year. We were averaging about 1,000 permits a year. Starting to come back up to, I was hopeful that we were going to end up around 1,500 permits a year. These are monthly numbers that are shown, but you annualize them, it ends up about 1,500 permits a year. New home construction just absolutely got decimated by the increase in interest rates. And in talking with home builders around the region, it's the modest new home prices that have been affected the most. If you're in the market for an $800,000 to $1 million plus home and you want to buy a new home, chances are interest rates don't matter to you that much. You've probably got cash. You might be paying all cash, but even so, you want what you want, you're willing to pay for it. The custom home market at the higher price ranges is holding up okay. But at more, again, it's not really an entry home when it's $350,000, but the price ranges that might be that next step home, those have really been impacted. Those buyers, when you couple the increases in costs because of construction and the increases in interest rates, it's just made it really, really difficult for them. And so that segment has really been impacted. I am very, very hopeful that if mortgage rates decline next year the way that I believe they will, that will actually, two things will help new home construction recover somewhat over the coming year. Number one is the decline in mortgage rates. That'll help improve affordability a little bit in the new home side. And number two, I think there is an element of acclimating. I do not believe that let me go again. When an economist says something with absolute certainty, you should be very, very afraid. We will never see 3% 30-year fixed rate mortgage again. Okay? I am very, very certain on that one. And so be afraid. If we do, it means there's something really strange going on. I'm one, some of you may have seen a post that I had, Paul Krugman did an article last weekend about the rise in the 10-year Treasury and whether or not that's a permanent increase. And I with all due respect to Nobel Prize winner, I tend to believe that that we are more back to a normal 10-year Treasury point than to go lower. We'll see what happens with that, but I just don't see the 10-year Treasury and therefore mortgage rates falling a lot below, this 6% mortgage rate forecast that we have. Could we get down to 5.5%? Absolutely, but I don't think we'll get much further below that. Well, how did I get onto that? I got onto that because we were talking about buyers getting acclimated to the mortgage rate environment. We got so used to having these interest rates that are below, 3% or even lower, that we started to think that's normal, even though it's not. And it does take a little bit of time for us to get used to the change in the weather when it goes from being 100 degrees. And my nephew came in town over the weekend and he was complaining about the weather we had last weekend because it was so hot from where he was. And I thought, no, this is nice. We had the 100-degree weather, now it's only 90. This is really great. And there's that acclimate, right? When it turns 90 in the spring and you're just like, oh my goodness, this is awful. You get used to it, and that's part of what we have to do with these mortgage rates. So I do think we'll see new home construction increase. There's one area, I had a really good touch that I was going there. There's one other area that I think is actually, I'm hopeful in terms of construction activity that changes the framework a little bit. I forecast single-family building permits. But in recent years, we've seen a big increase in duplex construction. So on this graph, the blue line is single-family building permits. It's a moving average to get rid of the seasonality. And then the red line adds single-family building permits with duplex permits. And you can see how the difference between those, it's gotten a lot bigger. And so there are more and more duplexes that are filling that. Now, again, there's been quite a drop-off in the face of the higher interest rates. And the other thing I'd say is that a lot of the duplexes have been built specifically for rental purposes. In fact, many of them have been essentially what I call two-family apartment complexes, right? They're a whole subdivision built to be owned by a single investor that will then be all rentals. And that's just an apartment complex of two-family units, fine. But we're also starting to see some builders that are looking at building what I prefer to call twin homes, where they actually have been a lot split and it is divided, where you have two owner-occupied units. And that is a way to be able to get in with a little bit less land than you could otherwise for two single-family homes, and a little bit less construction cost, which allows to get in a lower price point. And I'm hopeful that that will be a way that we can help pick up speed and build new construction to get us there in a more timely fashion than the 15 years it took us to get where we are. So my new home construction forecast, we're forecasting that permits are down 18% this year, big drop. But if mortgage rates fall the way we think they will, then that would lead to an increase next year. Just modest, but at least it's trending back in the right direction. So that is our overall housing forecast. I do want to make sure just one more time to give thanks to all of our sponsors. But with that, I am ready to take questions. How did I do on time? Good. All right, I saw you first, Vale. Construction cost per square foot. It has just, one of the challenges that we've seen with a lot of our inflation, we see the prices of a lot of different things, household goods, but also construction goods, went up tremendously. While a lot of the rapid appreciation has stopped, we haven't seen a lot of declines. And so it is just much more expensive. We would love to see, median sale price in Wichita is just below $250,000, which means that's half our homes sell for more, half sell for less. It is just almost impossible for a new home builder to build anything that would actually be competitive, have enough square footage and features to get in even below 300, even below 350 is hard, but 300 is probably the bare minimum. And again, It's just not comparable with what you'll find in the existing home market. Construction costs they're a tremendous challenge, both labor and materials. So, yes?
How do online marketplaces impact the numbers that you've seen regarding inventory, like Zillow and things like that? Are they reflected in these?
Yeah, so and the numbers that we report here are numbers, oh, I'm sorry, yes, idiot. You're a member of Rotary, you know you're supposed to repeat the question. So the first question had been about how construction costs per square foot and what's happened with construction costs. The second question had to do with how online marketplaces like Zillow and those impact the numbers. The numbers that we report and the numbers that we use are sales that go through a multiple listing service in the state. For the most part, any new home sales that happen go through the multiple listing service, including Zillow and those others. They're all participants in the MLS. That's how they get the data they need to do the things that they do. There are two groups of homes that really don't end up showing in the MLS. One is just the for sales by owners, and the others are going to be the houses that are bought by investors. Sometimes those homes don't always go through the MLS. Sometimes they do, sometimes they don't. The big question with that is whether or not there's a change in the fraction of homes. So, I'm less concerned about the number and more concerned about the changes. And so if we say, sales are going to go up by 0.8% next year. Well, if we included in all the others, I don't think that's going to make a meaningful difference. The actual number would be different, but it wouldn't change the underlying transition dynamics. So, other questions? This is dangerous when you ask Larry to ask a question.
No, it may be a little bit out of the realm. Some cities have taken on controlling or regulating Airbnbs as it affects home ownership. A lot of people have Airbnb or turn to Airbnb for their homes because they've relocated or whatever. Some do it as an investment. What's your overall thought on the potential that Wichita will try to control Airbnb?
Yeah, so the question is about Airbnbs and the impact that that has on housing markets. And in particular, I think your question is related to the supply challenges that we have. Generally speaking, when we talk about owner-occupied homes or renter-occupied homes, meaning somebody's living there full-time permanently, but they're renting it, I don't get too worked up about those changes in terms of a home going from owner-occupied to renter-occupied or back and forth, because you still have a household with a housing unit to live in, whether it's owner or renter-occupied. With Airbnbs and any other vacation home type situation, that actually does pull a housing unit out of the inventory of homes that are available for people who are living there full time. Now, so that is, I do think that's played some part in those inventory issues. There are a couple things that I think you need to keep in mind with that. Number one is a lot of the Airbnb numbers that you see and the things that you have. Remember, Airbnb started not as a notion of I'll buy an investment property and I'll rent it out. It started out as I've got a spare room in my house and I'm going to rent it out. And so a lot of the Airbnb listings literally are somebody's got a spare room in their house, and so that doesn't impact it, right? That piece of it doesn't impact things. So don't just look at a total number of Airbnb listings and think that somehow that's reduced the inventory. But the other is, we have a lot of experience in other markets with, Florida, for instance, where you have a lot of second homes and vacation homes and things like that. And markets over time adjust and adapt to deal with that inventory. So I don't think that that's necessarily something that you need to regulate in terms of, we have a shortage of housing stock. That's something you let markets adjust to. You try and get into micromanaging that, and that's a recipe for making mistakes. The other piece of it that I think, just in some conversations that I've had with some realtors across the state, and some of whom actually are in the Airbnb business, there are a lot of them that are thinking about getting out of it, not because of the regulatory issues, but because they just can't keep them rented enough to make it worth their while. And so they're either planning on turning them over into regular rentals or selling them. And in terms of the national research that looks at the impact of Airbnb and where it has that impact, The general conclusion that you have is that it's only in very, very tourist destinations that you see a big measurable impact of Airbnbs on a local market. I hate to say this, but Wichita is not that big, heavy tourist destination. I love Wichita, but I don't think that it's enough to really drive it for us. So, question.
I have a question. What's your opinion on the health of the commercial real estate market in Wichita, and of course the impact of the rapid uncertainties?
Yeah, so the question was, what's my opinion on the impact on commercial real estate markets in Wichita, especially in light of the rapid Fed funds increase? It's important to remember, and this is actually true with housing markets as well, every real estate market is local, okay? And so Wichita's market is different from Kansas City, is different from Dallas, is different from Denver, but it's also true across property types. And so in thinking about what's happening with real estate, commercial real estate, retail is in a very different world from office, is in a very different world from industrial, and there are subtypes within all of those. Certainly the increase in less the short-term interest rates, but the fact that the 10-year Treasury has gone up has put tremendous pressure on cap rates. And I've been a little surprised. So cap rates are basically a measure of the income to value. So think of it as an inverse PE ratio for commercial real estate, for those of you who like stock market analogies. It is, when those cap rates go up, per dollar of income, that means values are going to fall. And there has been some upward pressure on that. It has not been as great as I thought it would be. And in talking with people across the country on this, there are a couple things. Number one, there's a lot of real estate investment funds and syndicates and things out there, and they raise money from wealthy individuals to invest in real estate. And it's just not very sexy for them to go and say, yeah, I'm taking your money that you've given to me to do this, and we bought some 10-year treasuries. You might be getting a better yield on 10-year treasuries, but they're still going out and buying commercial real estate. And so that has kept cap rates lower than I thought they would have gone, okay? The other thing is that, I know there's a lot of concern, especially after Silicon Valley Bank and some of the other banking things that happened earlier in the year, about how this will impact commercial mortgage loans and how it will impact banks. And one of the interesting things that I've been hearing is that the play right now. So anytime something goes, anytime there's turmoil in financial markets or in real estate markets in particular, there are those who look at that's not a problem, that's an opportunity. That's an opportunity to find really good deals. And there's an awful lot of wealth that was created in Wichita by people who had access to cash during the savings and loan crisis that were able to help investors invest that all around the country and made hundreds of millions of dollars out of that deal. There's lots of cash out there looking for opportunities. The play right now seems to be in providing mezzanine financing. And what that means is, so instead of coming and, so I've got my loan at Fidelity. I'm sitting there looking at you. So I've got my loan at Fidelity. It's coming due. We're going to do an annual review. We're going to do a new appraisal on it because we do a new appraisal to verify that the collateral is good, and because cap rates have gone up, and maybe it's an office building, and occupancy rates have gone down. My value isn't as high. In order to renew my loan, I've got to come up with more equity. There are investors who are out there who are saying, tell you what, I'll provide you with this equity, Dr. Longhofer. I'll give you this equity. You give me a preferred return. You put me in a senior position over your equity position. And essentially they're in a place where they're saying, hey, if everything goes great, wonderful. I got this really nice rate of return on my commercial real estate investment and I got my money back. If everything goes bad, fine. Then I don't have to, then the original equity holders lose their money. I get control of the real estate. And that's where that seems to be more common right now, which actually then has me very sanguine about the prospects for there being some sort of severe commercial real estate loan problem for commercial banks. I just don't think banks are going to see as much come back as maybe some people fear. So, again, different markets have different situations. Retail is in an interesting situation, thank you. One thing I'll say about office markets is they're not nearly as challenged in Wichita as they are in large markets. I lived in Cleveland for 5 years, and I had a commute that was 50 minutes from the door of my house to sitting at my desk, each way. And I think about it, back in that day, if I could have had hybrid work or done something like that, I would have loved it. We don't have those kind of commutes in Wichita. And so our occupancy rates in office, while they're still not back to where they were pre-pandemic, they are much better than they are in some of those other markets. So when you hear some of the news in national news, recognize that national averages mask a lot of variation locally. Sorry, that was probably more than you wanted. So any other questions? I think I have time for one, maybe two more. Ann.
No, go to the back.
Oh, yeah. Nick.
Have we been impacted by large private equity firms like BlackRock or Blackstone buying a bunch of houses for cash, like in other markets?
So the question is whether or not we've been impacted by some of the large equity, Wall Street firms coming and buying houses, equity for cash. My perception of that is no, not really in the Wichita market. Now, Natalie, are you going to tell me I'm wrong? No, I'm looking at my realtor friends here because they're the ones who would actually see the people who are there. One of the nice things about being a tertiary market is that we can avoid some of the whipsawing effect that happens with some of the national Wall Street things that go on. And I think that helps make us a nice, slow, steady, stable place. Maybe we don't see some of the extreme highs, but we also don't see the drops. So, Ann, did you have another question?
That was my question.
Okay, excellent. Well, thank you all very much. It's been a great pleasure. I appreciate being here.